Good morning. Welcome to everyone here at our roundtable on trade through prohibitions, including those watching online. My name is Jamie Selway. I am the Director of the Division of Trading and Markets. We're pleased to host you today. I'd also like to thank Chairman Atkins for his leadership on these issues, and we look forward to his remarks later today. We'd also like to welcome our commissioners and ask Commissioner Peirce, followed by Commissioner Crenshaw, who will join us via video to offer their remarks on today's roundtable. Commissioner Peirce. There will be no trading through on this roundtable.
Good morning, and thank you all for being here. I've been really looking forward to this roundtable, and so I'm going to keep my statement short because I think they're more important people to hear from, and I touched recently on the trade through rule in a speech that I gave, so I want to hear from today's panelists, and we have a lot of great panelists and great moderators and fantastic issues for discussion. Today's focus, as you all know, is on Rule 611 of Reg NMS, also known as the Trade Through Rule, the Order Protection Rule, or simply OPR. It's not only that it has a rule, it's not only a rule of many names, but it's also a rule that inspires many different opinions. The rule was controversial enough when it was adopted in 2005 to prompt a lengthy 44-page dissent from Commissioners Cynthia Glassman and Paul Atkins. I had a small role then in cite checking the footnotes, which is a bad thing to give me because I've never been good at blue booking. But anyway, that was the extent of my role. 10 years later, in 2015, Rule 611 was the subject of the very first meeting of the Commission's Equity Market Structure Advisory Committee, which featured some of the panelists and moderators that we have here today. 10 years later, here we are again. Rule 611 remains in our rulebook, remains controversial, and remains a hot topic in Commission corridors. By now, the top line arguments are familiar. Critics of the rule blame it for increasing complexity, fragmentation, and costs, while defenders credit it for increasing competition and protecting investors. I'm eager to hear more in-depth discussion from our panelists, many of whom have spent their careers working in a marketplace shaped by Rule 611. The insights gained from today's discussions should help the Commission determine whether to move forward with amendments to the rule, and if so, what form those amendments should take. Should the rule be retained, repealed outright, or amended so as to apply only to exchanges above a certain volume threshold? If a volume threshold is appropriate, what should that threshold be? And if the rule is amended or repealed, should other NMS rules, such as the access fee cap in Rule 610 or the minimum tick size in Rule 612, also be changed? Should our thinking on the trade-through rule apply equally with respect to the joint industry plan equivalent in the options market? Does that market's experience with its trade-through rule inform or mirror the experience of, should it inform the experience that in the equity markets, and is it different in the options markets? On these matters, we'll benefit greatly from the wisdom of the panelists. Even with the wisdom of our panelists and the expertise and diligence of our staff, changing these rules will be no easy task. Our markets are dynamic systems made up of, among others, investors, exchanges, ATSs, broker-dealers, proprietary trading firms, and technology providers, each of whom operates with different incentives, business models, technical and operational capabilities, and risk tolerances. This complexity is wonderful and keeps our markets vibrant and competitive, but it makes the task of writing, amending, or repealing rules that regulate this market structure challenging. Compounding this challenge is the rapid pace of technological innovation, which alters the markets in ways that we cannot foresee. Any amendments we undertake must try to account for technological changes that we can anticipate, such as currently ongoing efforts regarding tokenization, as well as changes that we can't anticipate. That the task is a hard one should not foreclose the Commission from taking action, but it does underscore the need for us to be careful, deliberate, and collaborative in any changes that we make. Only then can we create durable change and beneficial change in our markets. Thank you again. I'm looking forward to productive discussion, and I just hope that we don't have to be here in another 10 years talking about the same topic. Thank you.
Amen to that. Commissioner Crenshaw, do we have Commissioner Crenshaw by way of video?
Can you hear me?
Yes, we can. Please go ahead, Commissioner.
All right. And I apologize if there's other noise around me. I was unable to make it today in person. But good morning, everyone. And I am pleased to welcome you to today's roundtable on Rule 611 to discuss the ins and outs of trade-through prohibitions. I am aware of the vast amount of work that goes into planning and executing roundtables. So I'd like to start by thanking Director Selway, the Division of Trading and Market staff, and everyone else who was involved in putting this together. I'd also like to thank our moderators and panelists for joining us today. I look forward to hearing wide-ranging perspectives on the role of trade-through prohibitions in our market structure from this impressive group of experts. Everyone here knows that the equity markets are complex and interconnected. Over time, new technologies, regulations, and other developments have caused the markets to change and evolve, sometimes in unanticipated ways that merit discussion. In order for the SEC to fulfill its three-part mission to protect investors, maintain fair, orderly, and efficient markets, and facilitate capital formation, we must continually reevaluate our approach to market regulation, making adjustments as needed to respond to changes. I hope today's roundtable can contribute to our efforts to improve outcomes for investors in this space, and for retail investors in particular, while also strengthening our equity market structure. On the topic of retail investors, the Commission discussed in the adopting release for Rule 611 that many of the investors whose market orders are executed at inferior prices may not, in fact, be aware that they received an inferior price from their broker or executing market. The release elaborated that advancing the interests of such investors in obtaining best execution on an order-by-order basis is a vitally important objective that warranted adopting the order protection rule. Given the important role that the order protection rule has been playing as a backstop for broker-dealers' duty of best execution, I'm particularly interested in hearing more from today's panelists about how trade-through prohibitions intersect with the fulfillment of best execution obligations. I believe that a market intermediary's duty of best execution is a cornerstone of our investor protection regime. The idea that a market intermediary must seek the best deal for its customers is fundamental to ensuring that investors can have confidence when they engage in the markets. And as I've said before, without investor confidence, the markets cannot serve the purpose as a place for investors to grow their savings while providing companies with needed capital. However, I also understand the reality of the proliferation of execution venues has increased market complexity, which may make things more complicated for market participants. As we move through today's roundtable sessions, I urge you to keep in mind the important role of the equity markets as a place where Americans can invest and grow their savings, from everything from retirement, a child's education, buying a new home, or taking a well-earned vacation. In order for the markets to serve this purpose, investors must have confidence in trading venues and market intermediaries, as this requires well-regulated, well-functioning markets that are efficient, competitive, and transparent. As I'm sure our experts here today will attest, market structure is critically important. I hope that today's roundtable will yield thoughtful discussion regarding the role of trade-through prohibitions in today's market structure, as well as creative solutions that consider improving both market efficiencies and outcomes for investors. Thank you again for being here today.
Thank you, Commissioner Crenshaw. Thank you, both commissioners, for your remarks, your valuable input on this event. I'd also like to thank my capable division teammates who worked diligently on today's program, in particular, Ted Venuti, Arisa Kettig, David Liu, and Kevin Brennan. Most importantly, we thank our moderators and panelists who will contribute a variety of expertise and experiences today to benefit the Commission and the investing public we serve. We are confident that your contributions will meaningfully inform the Commission's next step with respect to trade-through prohibitions. Before I begin, I must remind you all that my remarks today are provided in my official capacity as the Commission's Director of the Division of Trading and Markets, but do not necessarily reflect the views of the Commission, the Commissioners, or the members of the staff. Our division was the Commission's first, and it was initially known as the Division of Trading and Exchange. Our first director, David Saperstein, was appointed by Joseph Kennedy on August 1st, 1934. Speaking to the National Securities Traders Association on August 4th, 1936, in Los Angeles, Director Saperstein asked the following regarding the 2-year-old Securities and Exchange Act of 1934. In what direction has it moved? What progress has it made toward the goal of protecting the investor? These questions ought to be answered frequently, honestly, without heat and without dogma. The answers are of paramount importance to you in the securities business, to us in the business of government, and to the great, amorphous, myriad-minded entity that we designate the public. 70 years later, Reg NMS was adopted. The Division of Trading and Exchange was now called Market Regulation. The National Securities Traders Association had dropped its descriptor. Speaking to this group, the STA, in New York, on April 19th, 2007, then Commissioner Paul Atkins said the following of Reg NMS. The trouble is that the real consequences for our markets will not be known for years, after the damage has been done and after trading patterns have shifted in unpredictable ways and perhaps to other venues. Today's roundtable is an important marker along the path that markets have taken since Regulation NMS was adopted some 20 years ago. Our national market system has seen substantial change since that time. We've gone from markets dominated by a small number of venues to trading dispersed across many registered exchanges, and for equities, off-exchange venues. Indeed, we have seen a proliferation in the number of registered equities and options exchanges over the last 20 years. And over this time, trading volumes have increased manyfold, and latencies have become ever smaller. As Chairman Atkins foretold, many of these changes have been unpredictable, and the consequences and costs have been hard to discern. But as Director Saperstein urged, the Commission has a duty to evaluate its handiwork frequently and honestly. For example, Rule 611 focuses on price priority, but also includes a number of exceptions that recognize market participants may have other priorities when executing orders. Have trade-through prohibitions, with their numerous exceptions and exemptions, made our markets more competitive to the benefit of investors? Are there more efficient, less prescriptive means to enable competition and foster innovation in our markets? As a means to protect investors, how do trade-through prohibitions compare to the duty of best execution? Trade-through prohibitions necessitate additional policy choices, such as access fee restrictions and market data standardization. We appreciate that Rule 611 cannot be analyzed in a vacuum, and we look forward to exploring related questions with the benefit of public comment and possibly additional roundtables. To borrow from another Kennedy, we begin today with Rule 11, not because it is easy, but because it is hard. Your input is valuable, and we thank those who have already submitted comments. We hope to hear from you and many market participants as possible, Our goal is to ensure that we continue to have the best securities markets possible, competitive, fair, efficient, the model for the world. Today, we will hear first from the Division's Office of Analytics and Research, which will present highlights from recently published data intended to support today's discussion. This work is available on the Roundtable website and on the Commission's Market Structure Analytics page. For NMS stocks, the data describes trade-through rates, the number of broker-dealers trading directly on exchanges compared with those that route via other brokers, and changes in displayed liquidity over the past 10 years. For listed options, the data describes trade-through rates as well as related changes in options market structure over the last several decades. Following the presentation, the first panel will focus on market participants' experience with trade-through prohibitions over the past 20 years. After a break from lunch, the second panel will discuss a trade-through prohibition's role in today's highly automated and connected market structure. Next, the chairman will give his remarks, and then finally, the third panel will consider potential paths forward for trade-through prohibitions. Again, we thank you all for participating in today's roundtable. We look forward to hearing everyone's views on how to ensure our markets remain the envy of the world for the benefit of the great, amorphous, myriad-minded investing public. So now I'll bring up Dan Matheson, Arun Manoharan, and Jesse Brady for more. Dan?
All right. Thank you, Director Selway. My name is Dan Matheson. I'm a senior policy advisor here at the SEC. The last time I was at one of these roundtables was the one after the flash crash where I was an industry panelist. And now, up here as staff, it is my distinct honor and privilege to get to read the SEC disclaimer. This presentation has been prepared in our official capacity as staff of the Division of Trading and Markets, but does not necessarily reflect the views of the Commission, the commissioners, or other members of the staff. All right, another ambition realized. Let's go. All right, so all day today, our panelists will be discussing and debating the costs and benefits of Rule 611. But before we get to the main event, we thought it would be helpful to take a look at what's hopefully some highly relevant data. In this presentation, we're going to look at how broker-dealers deal with the proliferation of exchanges, trade-through rates with and without Rule 611 in place, some measures of displayed liquidity, again, with and without Rule 611, and we'll also take a peek at some similar data from the options market. So Rule 611 says simply that exchanges can't ignore displayed bids and offers from other exchanges and trade outside of them. Simply put, if there's a 32-cent bid somewhere, no broker-dealer and no exchange can trade at 31 cents without first going out and whacking that 32-cent bid. It's arguably the crux of the national market system, which is a bunch of rules that stitch together the exchanges in that they require trading venues to honor better displayed prices wherever they are. When this rule was passed with the rest of the rules in Reg NMS back in 2005, supporters hoped that it would give people a strong incentive to post limit orders, which will therefore lead to tighter bid-ask spreads, good market depth, reduced trading costs, and ultimately better capital markets. But like with all rules, benefits always come paired with costs. There is no such thing as a free bunch of regulations. So what are these costs? Well, strong arguments could be made against Rule 611 on a philosophical basis. Should the government be dictating where and how private individuals execute trades? But putting that aside, we're going to talk about on a practical basis. There have been two major concerns raised. One is, does Rule 611 lead to a proliferation of exchanges that have caused fragmentation of liquidity and therefore increased the complexity of execution? And two, has Rule 611 directly driven up costs for broker-dealers, causing them to have to connect to numerous small exchanges, which leads to increased servers, increased hardware in multiple data centers, expensive data fees and port fees, higher compliance costs, costs of coding all this stuff into their smart order routers, and more. So let's dive into some of the data and see what we can learn. To start with, for our viewers at home who don't eat and drink equity market structure every day like our panelists and like most of the people in this room here, how many exchanges are there? Well, currently, in the second quarter of 2005, and as of today as well, there were 16 exchanges that traded equities. These 16 combined did exactly half of the total trading volume, with the other half of the volume trading off exchange. The top 5 exchanges combined for 41% of equity volume, which leaves 11 exchanges that had less than 3% market share, and 8 exchanges that had less than 1% market share. So we do see a proliferation of small exchanges that have very low market share. And guess what? Several more are on the way, including the new 24 exchange, which will go live within 2 weeks. On the broker-dealer side, there were over 3,000 registered brokers in the second quarter, but only about 1/3 of them trade stocks. So we saw 1,124 broker-dealers who executed at least one share of equities in the second quarter. And now if all 1,124 of these broker-dealers had to connect to all 16 exchanges, that would be 17,984 connections. So is that what we see in the real world? No, that is not what we see. In this complicated routing ecosystem, the vast majority of broker-dealers choose not to deal with any of this and outsource all of their trading. Of the 1,124 broker-dealers that traded stocks in the second quarter, 762 of these broker-dealers completely outsourced 100% of their execution to other broker-dealers. They just pass the order along and let somebody else deal with complying with Rule 611 and the rest of Reg NMS. So there were only 362 broker-dealers who actually executed trades. Of these 362, 40% of them did all their trading off exchange, which left 223 brokers who traded at least one share on an exchange. Skipping to the punchline, there were 44 brokers that executed on more than 10 exchanges, and only 22 broker-dealers that executed on all 16 exchanges. And that represents even fewer than 22 organizations because some of those have multiple broker-dealers where it's under one parent firm. So there are fewer than 20 organizations out there that actually connect to every single exchange, defining a connection as they traded at least one share from April 1st all the way through June 30th. Now, these 20-ish organizations include bulge brackets, market-making shops, the exchange routing broker-dealers, and a few prop shops that are out there, proprietary trading shops. So what does this tell us? In the wake of Rule 611, the vast majority of broker-dealers have found it's no longer economically feasible for them to do what was once the essential function of a stockbroker, execute their clients' orders. Outsourcing execution reduces or eliminates the cost of complying with Rule 611. But on the other hand, it means that the broker-dealers who are closest to the end client are giving up control of their orders, potentially suffering delays and possibly lower fill rates, and potentially experiencing information leakage as more parties are touching the order flow. Now, slicing the data in a different way, how many broker-dealers connect to each exchange? Well, here we aggregated the 16 exchanges into 4 tiers based on their number of executing BDs. Now, importantly, the tiers are not the same as just a straight measure of volume. Like this is based on the number of broker-dealers an exchange has, not their market share. And so those two are not synonymous. You cannot just assume you can just back into which exchanges are in which firms. There are some fairly large ones that have a fairly small number of BDs on them, and there are also some, and as well as the opposite. We also report on how many member broker-dealers each exchange has. Consistently, there are a lot more member firms than there are firms who actually trade there. American Express used to say that membership has its privileges. The main privilege of membership at some of these exchanges appears to be to say you're a member. Now, the most connected exchange, which again is not necessarily the largest exchange, but rather the one with the most broker-dealers, had 172 firms that executed trades on it, while the least connected only had 24 broker-dealers that actually traded on it. Next, we take a peek at the number of broker-dealers who add versus take. Adding means posting a displayed limit order, while taking, for those who don't know, means hitting bids or taking offers. Now, Rule 611 requires you to take liquidity on any exchange, but it doesn't require you to add liquidity anywhere. So we wanted to see if there were a large number of broker-dealers who only take at the smaller exchanges. This does turn out to be the case. Consistently, there are more taking BDs at almost every exchange than there are adding BDs. And it's particularly true with the smaller ones. For example, the least connected exchange, which again is not necessarily the smallest exchange, which only had 24 broker-dealers that took liquidity on it, only had 10 broker-dealers who voluntarily provided liquidity. Now, the previous slides looked at the number of broker-dealers who go directly to exchanges, and we saw the vast majority of broker-dealers outsource their trading. But when you look by share volume, it's the opposite. The vast majority of shares are executed by broker-dealers who originated the order. Only 28% of shares and 18% of total dollar value traded was outsourced to other BDs. So how could this be the case that almost all broker-dealers are outsourcing, and yet 72% of flow is executed by the same broker who originated the order. Well, this speaks to the concentration of trading that we have seen in the wake of Reg NMS and over the last 20 years. While only 22 broker-dealers connect to all 16 exchanges, the vast majority of flow is originated by these 22 broker-dealers. Now, did Rule 611 make routing more complex and costly? Did that lead to smaller broker-dealers throwing in the towel on the execution game, while the bigger broker-dealers realized greater economies of scale? And is that a factor that led to this highly concentrated broker-dealer landscape that we see today? Well, I will leave that to the panels to discuss and debate. And with that, I will pass the baton to Arun Manoharan, the Assistant Director of the Office of Applied Research, who is now going to review some very interesting trade-through data. Arun.
Thank you, Dan. I see a lot of familiar faces, but for those who don't know me, my name is Arun Manoharan. Any attempt to pronounce my last name is much appreciated. I've been at the SEC for 12 years, and with that, we can begin. To facilitate today's discussion on Rule 611, we produced analysis that looks at trade-through rates. To accomplish this, we examined all regular way trades for the second quarter of 2025. Our intention was to look at situations when Rule 611 applied and when it did not, thereby answering the question, do trade-throughs increase when Rule 611 is not in effect? To answer this question, we separated these trades between 3 sessions: the pre-market, regular, and after hours. We also separated trades between round lots and odd lots. We then counted the number of trade-throughs that occurred during the different sessions and separated them by odd lots and round lots. Rule 611 also has a provision that allows for a 1-second look back, letting one compare the execution price of a trade to either the lowest bid or the highest offer that occurred 1 second prior to the trade taking place to determine if a trade-through has actually occurred. We also counted the number of trade-throughs after applying a 1-second look back. We divided our analysis between corporate stocks and ETPs. For corporates, trade-through rates without the look back for all sessions for both round lots and odd lots was 2.4% or less. When we applied the look back, trade-through rates dropped to less than 0.55% for all size trades. Looking more closely, trade-through rates for round lots during regular trading hours dropped to 0.06%, but remained at similar levels for odd lots when compared to other trading sessions. For ETPs, trade-through rates without the look back for both round lots and odd lots was less than 2.1%. But after applying the look back, trade-through rates dropped to 0.6% or less. Trade-through rates for round lots during regular trading hours was 0.08% and increases to 0.25% for odd lots. When the SEC adopted Reg NMS, it stated that one of the primary goals of intermarket price protection was to promote displayed liquidity. We're going to visually inspect a daily empirical cumulative distribution function time series from 2015 to 2025 for 2 time-weighted liquidity measures. Those 2 measures are the number of round lots at the national best bid and the number of best bids at the national best bid. These data were derived from SIP quote messages and NBBO appendages that were in force during regular market hours. The ECDF is used to show the percent of NMS stocks at or below a particular value of the liquidity measures. And I use a lot of acronyms, but we have so many experts here, I'm sure you know what they all mean. Here, we're looking at the daily ECDF for the first liquidity measure, the number of round lots at the national best bid. The x-axis is time, the y-axis is the percent of NMS stocks, and the z-axis, represented by the color gradient, is the liquidity measure. Looking at the ECDF, there are several observations that stand out. The percent of NMS stocks having over 25 round lots at the national bid increased from 15% to 25% since 2015. While at the same time, the percent of NMS stocks having 3 or fewer round lots at the national best bid remained relatively constant at 20%. Here, we're looking at the daily ECDF for the second liquidity measure, the number of best bids at the national best bid. Once again, there are several observations that stand out. The percent of NMS stocks having 2 or fewer best bids at the national best bid remained at approximately 40% from 2015 to 2025. Over that same period, the percent of NMS stocks having over 6 best bids at the national best bid increased from 5% in 2015 to 20%. During this time, the number of exchanges increased from 11 to 16. With that, I will hand it over to my colleague, Jesse Brady, to talk about options.
Thank you, Arun. My name is Jesse Brady, and I am also in the Office of Applied Research. Now we'd like to switch gears and discuss the options market. The period included in this study saw unprecedented growth, both the scale and the prominence of the options markets in the United States. As we've shown here, options markets have had 2 distinct periods of rapid growth. The first being from 2000 to 2009, labeled the linkage era here, and then again from 2019 to present, labeled as the zero commission era here. In between these 2 periods was a period of relatively flat growth in the options market from 2009 to 2019, labeled here as the consolidator era. As shown on the very top of the image, the options markets are currently operating under what we've labeled as the options plan, also known as the options order protection and locked cross markets plan, which is the corollary to the equity markets rule 611. Following the options plan approval in 2009, the U.S. options market experienced a milder, steady period of growth for nearly a decade before the broad adoption of zero commissions and a confluence of other factors amplified the growth of options markets beginning in around 2020. For options data, we reviewed the options trades for a 5-year period from 2020 to 2025 and compared the trade prices on each trade to the prevailing NBBO from OPRA and found that the rate that trades occur outside the NBBO has remained fairly steady between 1.1 and 1.6%. Of these trades that happen outside the NBBO, the vast majority, around 75%, included sale condition codes that help identify the exemptions to the options plan that they were executed pursuant to. The remaining 25%, which represents less than half of 1% of the total trades, did not specify an exemption and may represent trade-throughs, and is roughly the same rate as discussed earlier in equities. Another material change in the options market during this period has been an increase in the fragmentation of trading across options exchanges, as well as a proliferation of additional exchanges. In 2017, the options trading was concentrated in the top 5 exchanges, which collectively held over 70% market share. By 2024, options trading was more widely dispersed among the exchanges, with no exchange representing over 20% market share and 15 venues with greater than 1% market share. One important difference in the options market to keep in mind is that Rule 610, which caps access fees in equities, does not apply to options. Broadly speaking, these fees are higher for options than they are in equities. Additionally, this discrepancy could grow larger if changes to Rule 610 are implemented. In conclusion, we wanted to add a few pieces here for further examination. Some of these will be discussed in the upcoming panels. The first are the compliance costs, which are borne by both the industry members as well as execution venues. Further thought should also be given to the impact to market structure complexity. We also need to consider unintended consequences of trade-through prohibitions. It's good to keep in mind of how any changes may impact the alignment of best execution obligations throughout the market, and the impact any changes may have to ongoing automation efforts, as well as future connectivity decisions across this space. We would like to end by thanking everyone for the opportunity to discuss this topic. We really appreciate the engagement and feedback we've received already on our work or we may receive in the future. Thank you all for your time, and Director Selway, thank you for the opportunity, and I'll turn it back over to you.
Well, thank you, gentlemen, and Dan, you win the contest for correct pronunciation of Arun's last name. So panel one, can we have you up here, please? All right. Well, thank you. I'd like my pleasure to introduce an old friend of the agency, former Commissioner Mike Pivar. Mike is currently Executive Vice President at the Milken Institute of Finance Foundation. He and I will take us through the first panel today. So over to you, Mike.
Thank you, Jamie. And thank you for all the panelists for agreeing to be here today. I'm so pleased to be back here in this familiar place, moderating our panel of expert market participants on their experience with trade through prohibitions over the past 20 years. Before we start our discussion, I'd like to take a few seconds to talk about what Chairman Atkins calls a new day at the SEC. For 4 years, SEC reporting companies, regulated entities, and staff endured what can accurately be described as the dark ages of the Commission's history. That all changed in January of this year under Acting Chairman Ueda's leadership of the Commission and Commissioner Peirce's leadership of the Crypto Task Force. And now, under Chairman Atkins' leadership, the agency is reaching a full renaissance. Today's public roundtable is just one example of that revival, and I'm pleased to play a small part in it. So let's get started. I'm going to ask each of our panelists to give a brief 2-minute overview of their overall experience with trade through prohibitions over the past 20 years. And after that, we're going to drill down on some of the specific areas of discussion, some of which were mentioned by the commissioners and the staff when they went through their presentation. We've assembled a great group of experts representing a diverse set of market participants. And I'll note that some of them have held different positions at different firms over the past 20 years where their experiences may be relevant to our discussion. So let's get started. We'll just go in alphabetical order to get everyone's overall experience, and then we'll drill down into some of the specific ones. First, I'd like to call on Julie Andres, who's representing the Security Traders Association and KeyBank Capital Markets.
Good morning, and thank you for having me here. It's a pleasure and honor to be here among business and thought leaders in our industry. As you said, I'm Julie Andrus. I'm a managing director at KeyBank Capital Markets and Institutional Sales Trading. In that role, I'm responsible for best execution from our institutional clients, but I am here today in my role as the chair of the Security Traders Association, better known as STA. I've been in this role for I've been on the board for the past 6 years and been involved in STA for the last 10 years. The Security Traders Association is a professional group of financial service industry that was established in 1934. We have a diverse membership, both geographically and within roles in the marketplace. Our members include asset managers, RIAs, retail and full-service broker-dealers, vendors, exchanges, and clearinghouses. STA was actively involved in the process of modernization of the U.S. equity markets that culminated in the adoption of the Reg MMS over 20 years ago. And STA believes that regulators need to remain diligent in how rules impact the modern markets, and dialogue, such as today, fosters events like the roundtable today can create positive change. Given the change and the technology in the marketplace over the last 2 decades, STA supports a rule of 611.
All right, thank you, Julie. Now I'd like to go to Ari Burstein, representing Intelligent Cross.
Great, thank you, Mike. Good morning, and thank you for the opportunity to participate here today. My name is Ari Burstein. I'm General Counsel and Chief Policy Officer for Imperative Execution, the parent company of the Intelligent Cross ATS. Launched in 2018, Intelligent Cross is widely used by most major U.S. broker-dealers and electronic trading firms. In August 2025, our average daily market share was 2.1%, and Intelligent Cross has been consistently listed first since March 2025 in total shares traded by ATSs in the FINRA ATS weekly statistics. More importantly for the discussion today, we operate an ATS that displays its quotes to the public, but these quotes are not readily visible to all investors because they are not protected quotes. The lack of trade-through protection has created a situation that has allowed market participants to miss or effectively, quote-unquote, trade through the Intelligent Cross quote, even when it is the best displayed quote in the market. Our experience, therefore, with the trade through prohibition comes from the perspective of what we have seen as a venue with display liquidity operating without our quotes being subject to such protection. We have seen the concerns raised 20 years ago in the dissent, which Commissioner Peirce mentioned this morning, by then Commissioners Glassman and Atkins on Reg NMS, and trade through prohibitions come to fruition in our case as the continued inability for our quotes to be considered protected quotes has, again, at least in our case, stifled the introduction of innovation and competition to the displayed markets and has involved the Commission in the exact types of subjective judgments around protected quotes that the dissent warned about. For these and other reasons, Intelligent Cross believes that it is fair for the Commission to consider whether trade through prohibitions are still needed, whether other obligations such as Best X may offer a better balancing of the goals of competitive markets, execution quality, and customer choice, or if the Commission determines to keep the trade through prohibitions in place, how to modernize the rule to reflect today's markets. We commend the Chairman and the Commission for organizing today's roundtable, and I look forward to answering any questions you guys have. Thank you.
Thanks, Ari. Next up is Peter Haynes representing TD Securities.
Thanks, Michael. Good morning. My name is Peter Haynes. I'm responsible for index and market structural research at TD Securities in Toronto. Over my 30 years in this role for TD, I've come to a few conclusions with respect to market structure. Number one, it's regional in nature. Number two, every market has its own nuances. And number three, the U.S. market is on an island all by itself. For this reason, while important lessons can be learned from experiences in other jurisdictions, one should not assume that what works elsewhere will necessarily work in the U.S. equity market. From my perch in Canada, we Canadians look at the U.S. market with envy, and I'm sure this is the case for practitioners in other geographies. Here are some pretty impressive stats. The U.S. market is over 63% of total world capitalization. In fact, if you remove the S&P 500 stocks from the U.S. market, the residual stocks in the U.S. companies would still be 35% bigger than any other market in the world. Given this total world domination, it's not surprising that issuers from around the globe are looking to migrate to U.S. capital markets in search of higher valuations and inclusion in the holy grail of benchmarks, the S&P 500. Meanwhile, the U.S. continues to win the IPO battle with high-profile names such as StubHub, Klarna, and Figure Technologies going public just in the last week. And I don't think we've had 3 IPOs in Canada this year. In addition, volume of trade continues to favor the U.S., and this includes the battle for interlisted volume between Canada and the U.S., a battle the U.S. continues to win with now over 70% of the share of interlisted trading by one metric. This migration of flow to the U.S. from Canada is drawing concern from Canadian participants who are searching for answers to protect the future of Canada's capital markets. Quite simply, the U.S. is winning by any metric, and while it's never a good strategy to rest on success, we believe that material changes to market structure and resulting second derivative effects need to be thought through carefully to avoid unintended consequences. That said, rules do have best before dates, and for this reason, a discussion on important market structure tenets that have been in place a long time and are taken for granted, such as Rule 611, are worthy of review. And I commend the SEC for gathering such an impressive group of market practitioners to help guide the regulator in determining pros and cons of changing 611. So you have 3 options. Option 1, of course, is leave as is. I believe this is the least appealing of the options. I think if the goal of 611 was to ensure competition amongst markets or exchanges, that mission has been accomplished. Option 2 is the threshold rule, this notion you've heard about from Canada, which I'm sure we'll talk a little bit about later on. Canada instituted a threshold policy in 2016, and proponents of this rule will argue that it did achieve the goal of stopping non-differentiated markets from launching. It is true, however, I would, as I'm sure we will discuss a bit later in this panel, the actual goal of Canada's order protection rule and threshold rule was actually to stop the parabolic increase in real-time market data fees that exchanges were charging because each new marketplace required connectivity, and we didn't have a SIP that redistributed fees the way the SIP does in the U.S. Option 3, of course, is full elimination of trade-through rules. This idea has merit. I think, obviously, the threshold rule should be considered as well. There's a lot of questions that come, and it should be obviously a hotly contested topic. But at the end of the day, there's not easy answers for the implications of relying specifically on BestX for routing purposes. It is true that a BestX framework works in other geographies across the Atlantic. However, trading in Europe and the UK is much different than trading in the US, and in particular with respect to the incredible depth and liquidity that comes from direct retail participation in the US. It's also very important to think about a no trade through rule when considering the possibility that a whole new avenue of trading equities in token form outside the current infrastructure might result in a complete decentralization of trading, making the task of finding liquidity difficult, if not impossible, for institutions. And once again, I thank the Commission for getting the group together. I look forward to answering any questions.
Yeah, thank you, Peter. Yeah, we'll definitely get into discussions of differences in markets that either have different trade through prohibitions or don't have them at all and get the experience there. So thanks for teeing that up. Next up is Chris Isaacson from SIBO Global Markets.
Thank you, Mike. Thank you, Jamie. Thanks, Chair Atkins and fellow commissioners for the opportunity to participate today. My name is Chris Isaacson. I'm the Executive Vice President and Chief Operating Officer of SIBO Global Markets. We operate 25 plus markets around the world, including prominent options and equity markets here in the U.S. as well as in ATS, and have long served as a steward of innovation in the U.S. markets. We appreciate the Commission's thoughtful engagement on trade through prohibitions and welcome this dialogue. At SIBO, we believe markets thrive when innovation and competition, not regulation, are the primary drivers of change. That said, when regulatory frameworks become deeply embedded in interconnected market ecosystems, as the trade-through rule has, it's important to proceed cautiously and to fully analyze the potential impacts of any reform. While its original intent can certainly be debated, and I'm sure will be today, its practical impact is clear. Rule 611 has fundamentally shaped our market and contributed to the national best bid and offer, which is foundational to investor confidence, execution quality, and public price formation. We believe a central goal of this discussion must be to maintain a strong NBBO and public price formation in order to foster continued trust and participation in our markets, particularly among retail investors. Additionally, we urge the Commission to recognize the fundamental differences between the equities and options markets and believe these markets should be reviewed separately. The U.S. options market is strong, resilient, scalable, and continues to meaningfully and positively advance and grow dramatically, as Jesse mentioned earlier, absent regulatory intervention. If changes to trade-through rules are pursued, we recommend a measured approach that also considers other aspects of Reg NMS and market structure that may need to be revisited in concert to foster greater innovation and competition, such as best execution expectations, the prohibition on locked markets, and access fee caps in equities. In closing, we thank the Chair for convening this roundtable and look forward to participating. Thank you.
Thank you, Chris. Yes, we will get into differences between the equity markets and options markets in this discussion. Next up is Katie Colchin, representing the Securities and Industry and Financial Markets Association, SIFMA.
Thank you. Good morning. I am Katie Colchin, and I'm head of Equity and Options Market Structure at SIFMA. Thank you to the SEC for allowing SIFMA on behalf of its members to join this important conversation. Market structure can be thought of as an octopus with its many tentacles or arms. Its arms can move in multiple directions, all by changing shape in a variety of ways. Its arms are incredibly flexible, enabling infinite and complex, yet precise movements. Its arms can move independently, yet are interconnected. In fact, an octopus's nerves do not just run the length of a single arm, but can also connect to an arm 2 arms away. Its arms can even continue to move after death. Like the octopus, market structure involves many moving, interconnected pieces, and Rule 611 represents the head of this octopus. If you move or change one piece, other parts could move as well. As such, before making any changes, it is important to identify and analyze interconnected market structure pieces and study what corresponding changes could stem from any intentional change, as well as the cumulative net effect of changes. After all, unlike in economic studies, all else is not equal. One change will most likely lead to other changes. So when assessing changes, it is important to ask, what is our intent? What harm or harms are we trying to eliminate? What benefit or benefits do we expect to stem from the change? And what could be the unintended consequences of change? It is critical to ask these probing questions and perform rigorous analyses before making any changes, particularly to the head of the octopus, prohibitions on trade-throughs. The U.S. capital markets are the envy of the world, as Peter just told us, and not only the largest, but also the deepest, most liquid, and most efficient. Investors, both retail and institutional, enjoy narrow spreads, low transaction cost, fast execution speeds, high levels of pre and post-trade transparency, and strong investor protections. Moving forward, it remains important to continue to ask these questions and analyze what changes could mean for all investors. This is particularly true today as the landscape for modern securities markets is under consideration in conjunction with the incorporation of emerging technology platforms. After all, in 2005, one of the objectives of Reg NMS was to modernize markets, and here we are today discussing unintended consequences. We appreciate that the SEC is asking these questions, and we look forward to any resulting analysis of potential changes today and going forward. Thank you for inviting me today, and I look forward to the conversation.
Thank you, Katie. I did not have octopus on my bingo card, so thanks for that. That's a great analogy. Next up is Dave Lauer, representing Urban Finance and We the Investors.
Thanks, Mike, and thank you to the commissioners and chair for having me and convening this roundtable. I'm here representing Urban Finance, a company that connects retail investors with public companies and issuers, as well as We the Investors, a grassroots campaign to modernize and improve the fairness of equity market structure and represent hundreds of thousands of retail investors who care about these issues. But my experience spans quite a bit of this industry. I started in 2005 as Reg NMS was being implemented. I worked as a high-frequency trader and quantitative researcher trying to navigate the new complexity of modern electronic markets. I've worked with stock exchanges at various stages, an innovative exchange that started up and actually benefited from Rule 611, IEX, as well as sat on the board of Equitas Neo for 7 years and watched as the market share threshold and the intentional delay threshold criteria were put in place, and one of our venues lost order protection, and I saw the consequences of that on execution quality. We've seen a massive increase in fragmentation, that's for sure, but a big problem with fragmentation is that it has been fragmentation without innovation. For the most part, we've had mostly copycat exchanges approved by regulators that serve little purpose but to extract rents for data and connectivity. There has been very little innovation from the exchange space and very little benefits from competition, except for a small handful of venues across the world that have tried to do something different, who have seen better execution quality results, but who still struggle to gain market share because of the maker-taker model. So the octopus analogy is actually quite excellent because everything is interconnected, everything is enmeshed, and it's very hard to separate out the effects of a single rule versus the entirety of Reg NMS. I'm happy to be here to discuss what my experience has been, but I do see it as an important conversation that we need to have on a broad basis. We need to be talking about best execution as part of this conversation, because if we expect best execution to take the place of Rule 611, we have to accept that at this point, Rule 611 has become the standard for best execution, and that the current state of best execution is that it is neither enforced nor enforceable. And so if we're going to make any changes to order protection, we must consider the implications on best execution and what the retail experience will be when they can't be guaranteed that they are going to get a trade at the price that they're seeing. So thank you. I look forward to the conversation.
Yeah, thank you, Dave. And yeah, Commissioner Crenshaw specifically mentioned that too, so we'll get into that discussion too. And next up is Joe McCain from Citadel Securities.
Thanks, Mike. I'm Joe McCain, head of Citadel Execution Services at Citadel Securities. I also was part of the Equity Market Structure Advisory Committee for 2 terms under then Commissioner Pivovar, and I will echo, that was about 10 years ago, so I'll echo Commissioner Peirce's statement that I hope to not be here in 10 years discussing the same topic. But I do appreciate the opportunity to speak today. I'll summarize my points on the trade-through rule in 4 primary points to make. First, while we understand a lot of the arguments for why people would think that the trade-through rule is no longer necessary in today's market, we worry that removing the trade-through rule would be very complex, potentially disruptive, especially to retail investors, and the unintended consequences would not warrant the risk of removing the rule. We also think it would be very difficult to try to separate, if not impossible, the positives and negatives that the trade-through rule has impacted on our markets. However, we also understand and would agree that one of the frictions that has developed in the markets compounded by the trade-through rule has been the proliferation of venues and exchanges, which has increased the cost and complexity to investors. In our estimation, we did a calculation which takes Dan Matheson's breakdown a little bit further, and we estimate that the increased cost to the industry from small venues, small equity and options venues, is about $375 million a year. And we also think that removing the trade-through rule would not do a lot to impact that cost. So we believe that any action to try to reduce those costs and frictions to investors would require direct action, which we have suggestions that I'm happy to go into at a later stage. Third point is we do feel strongly that under the trade-through rule, protection should be given to automated quotes, and quotes that introduce intentional delays should not receive protection. And the fourth point that we would make is that as the SEC and the Commission is thinking about changes to equity market structure around 611 or other rules, we should be thoughtful about the compounding impact of other rules. One that we would highlight is the change to tick sizes and access fees, which was passed by the previous administration. We would suggest thinking about that rule in the context of whether we're making counterbalancing changes at the same time. We would encourage changes such as along the lines of that magnitude being conducted along an A/B test and ensuring that the changes that we do introduce do have the desired effect on our equity markets. Thank you.
All right. Thank you, Joe. Next up is Maureen O'Hara from the S.C. Johnson Graduate School of Management at Cornell University. Maureen has written numerous articles in market microstructure. Her book, Market Microstructure Theory, is literally the academic Bible that every PhD student reads. And she'll give the academic perspective on this. So, Maureen?
Well, thank you, Mike, and thank you, Jamie and the Commission for inviting me to be here on this panel and joining my fellow panelists. Like Joe, I was on the Equity Structure Market Committee in 2015. I was also on the Flash Crash Commission. So, and I was chairman of a broker-dealer firm for many years. I want to talk a bit in my time, when we go a little later, about the academic research on all of this, because one of the things that I think academics can bring is a bit of an outside perspective. I will say that using data in 2008, fragmentation that came, I believe, in part from the order protection rules actually looked kind of like it was doing a good thing. Back then, the research showed that there were lower transactions costs, faster execution speeds, there was higher volatility, but market prices seemed to be closer to random walks. But that was then, and now we're here. And I think that most of the academic research that I'm familiar with, some of it I've done, it sort of raises serious concerns about where we are. One of them is simply there's not enough of the order flow now that's actually covered by order protection rules. The amount of non-displayed liquidity is huge, both with respect to the odd lot quotes, which we can talk about later, but also with respect to the non-displayed hidden liquidity, and none of them are protected. And when we look at sort of what the protection actually does, it's just not comprehensive enough. And part of the challenge also lies in the NBBO, right? The National Best Bidder Offer, I think, is now rather misnamed. It's really the NPGBO, the National Pretty Good Bidder Offer, right? It's not very good. It isn't very good because there are so many odd lot orders that are sitting there. They're unprotected. They're also at better prices. And so when we talk about best execution, it's not happening for a large fraction of trades, particularly for the higher price stocks. And again, as we look at these issues, it's very important to realize that back in 2005, there was, I think, let's not talk about Berkshire Hathaway, but I think there was one stock that was above $1,000 a share. That's not the case now. And a round lot, even under the new round lot rules, will still essentially be the exception and not the rule for many, many investors. And so there are so many problems currently, I think, with trade through that I'm of the opinion that we're probably better off without it. But if we can't get there, we definitely have to make dramatic changes. And we'll certainly discuss that more in a few minutes.
All right, thanks, Maureen. Next up is Pankaj Patel from Bank of America.
Good morning, and thank you to the SEC for hosting these very important roundtable discussions on Rule 611 and whether it's fit for purpose in our markets. My name is Pankaj Patel, and I serve as the Global Head of Equities Electronic Trading Platform at Bank of America Securities. The platform my team oversees provides a wide range of execution products, including algorithms, smart order routers, and direct market access across our two client segments we service at Bank of America. First, the high net worth and retail segment, where we facilitate and provide best execution services for over 3 million clients on the Merrill Lynch platform. Second, the institutional and broker-dealer segment, where we facilitate and provide best execution for over 3,000 institutions on the Bank of America Securities platform. On any given day, our platform is approximately 14 to 15% of U.S. equities volumes and touches 1 in 6 trades a day. Over the past 25 years, I've had the privilege of being a practitioner at the forefront of electronic trading. I've designed and developed algorithms and smart order routers both before and after the implementation of Reg NMS. People often forget that leading up to Reg NMS in 2024, we were experiencing one of the most transformative equity market transformation in the equity market structure. You had decimalization, technological advances. All of this led to new trading venues, new systematic trading market participants, along with the first generation of execution algorithms and smart order routers, which truly revolutionized the way clients traded and liquidity was provided. Despite these innovations, challenges persisted at the time. Trying to adapt algos on a slow market that was manually driven proved to be problematic and required regulatory attention. The passage of Reg NMS in 611 really was that watershed moment for us. It was the catalyst to force the floor to finally adapt, and the legacy way of trading as we knew it was finally behind us. While Reg NMS and Rule 611 have provided a framework for modernization, it also triggered an even more sophisticated technology arms race. Participants with superior infrastructure sought to exploit latency and regulatory arbitrage opportunities and took advantage of exchange proximity, matching speeds, and how fast quotes were being disseminated. Brokers, unable to keep up with the infrastructure costs and co-location costs and subscribing to those market data feeds at the time, were susceptible to negative outcomes. If you were a broker who wasn't co-located by 2009, you were definitely experiencing some of these subpar outcomes of the market structure. These pains were real for investors, but the industry ultimately adapted at great cost. But by enhancing their technologies, they've avoided these negative outcomes. Simultaneously, over the years, best execution combined with ongoing innovation and improvements in technology have significantly enhanced execution quality and transparency for both retail and institutional investors alike. Rule 611 in particular has provided an additional level of comfort to our retail customers, knowing that their held limit orders greater than 100 shares would not be traded through. Unfortunately, the comfort level provided has come at some cost to the overall industry. 611 has directly led to proliferation of exchanges, fragmentation, and the undue complexity, resulting in an expensive tax the street continues to endure. Additionally, the fundamental market dynamics have substantially changed since 611 was passed. Today, odd lots are 70% of the trades. 2005, they were 20%. Today, the median trade size in the continuous session is just 77 shares, down 75% since 2025. Today, the displayed lit exchange volume is now only at 30% of the continuous session. In conclusion, there is no doubt that Reg NMS from the outset provided tremendous benefits to equities market structure, But like anything that is 20 years old, it is ripe for an upgrade. It is definitely time for us to take a fresh look at 611 and other structural rules, as some of the unintended consequences have led to enormous costs, fragmentation, and unnecessary complexity that continues to balloon. Thank you.
Thank you, Pankil. And last but not least, with an alphabetically disadvantaged last name, is Chris Solgan from the MIAX Exchange Group.
Thanks. And being last, I'll try to be brief. Good morning, and thank you for having me. My name is Chris Solgan, and I'm Senior Counsel with the MIAX Exchange Group. MIAX appreciates the opportunity to participate in this very important roundtable to discuss the trade-through rule. MIAX operates multiple markets across a diverse cross-section of asset classes, including 4 fully automated electronic options exchanges and an equities exchange, all impacted by trade-through prohibitions. And just last week, MIAX Sapphire launched an options trading floor in Miami, Florida. MIAX is fully supportive of a healthy review of a rule that is nearly 20 years old. We are in favor of innovation and reviewing older regulations to ensure that they still work for the markets. Continued industry engagement on the trade-through rule and potential changes should continue. In adopting NMS over 20 years ago, the SEC held numerous roundtables, and there was prolonged industry engagement. The Commission re-engaging the industry on this important market structure issue is very refreshing. MIAX believes that the trade-through rule has been generally good for the markets and helped to promote displayed liquidity and price protection. It has become ingrained in our market structure's DNA. Today's roundtable is to cover the trade-through rule in both equities and options. However, the equities and options markets are fundamentally different, and we agree with SIBO that any consideration of potential changes to their applicable trade-through prohibitions should be reviewed separately. In short, MIAX believes that the trade-through rules should be retained, but potentially modernized to reflect changes in the marketplace since it was first adopted over 20 years ago. We encourage that any changes, whether tweaking or possibly repealing, consider the value of a displayed quote in the marketplace, the importance of the NVBO, and the need for on-exchange liquidity. We again applaud the Commission in engaging the industry in reviewing this important regulation and look forward to working with the Commission and others in the industry on potential changes to improve the rule to reflect today's market structure. Thank you.
All right, thank you all. Now what we're going to do is go and look at some of the specific issues that the folks in the panelists mentioned on their opening statements, as well as some of the issues that the staff highlighted in their report and some of the issues that the commissioners mentioned in their opening statement. The first one we want to look at is the costs. When the Commission finalized regulation NMS 20 years ago, like it does with every regulation, it considered the potential cost of the order protection rule. And at the time, they did their best. They used public comments to try to figure that out. But as Jamie mentioned, Chairman Atkins pointed out that it would take years to actually figure out what the realized actual costs were. So let's drill down on that. And so for this discussion, I'd like to include any direct compliance costs, including staffing, training, technology, legal, and accounting. Do look at the effects of things like fragmentation, people have mentioned, broader economic costs, such as any reduction in market efficiency or competition. Dan Matheson had mentioned concentration in the BD landscape, any unintended consequences that were not foreseen when the rule was promulgated, and any other relevant costs. And for this, I'd like to start off, let's have Katie, since you specifically mentioned it, had the cool octopus analogy.
Okay, thank you. I guess I'm the scene setter here. So as I mentioned earlier, market structure involves many moving interconnected pieces, and it can often be difficult to identify one piece of market structure as the sole driver of any change or changes over the last 20 years. That said, it's always good to evaluate the evolution of markets. After all, we're on the history panel. So one of the original objectives for NMS was to correct market inefficiencies from the ITS system, essentially creating the National Automated Connected Market System. 20 years later, you cannot argue against the fact that we are automated and connected. However, the market landscape has changed significantly, so I'm going to run through some numbers for us, again, being cognizant that it's not that just one of these numbers caused these changes, everything works together. So let's start with volumes. Back in 2004, ADV was just around 4 billion, and now we're over 17 billion. And 90% of that was traded on exchange back then, where today we're around 50-50 on and off exchange. The total U.S. equity market cap was just 15 trillion back then, and it's over 60 today. And the SPX alone was around 10 trillion back then and is over 50 trillion today. When you look at trading venues, back in 2004, we were at 7 versus 16 today, with more in the pipeline. The number of ATSs was estimated at around 10 versus, as of 2Q, 33 today. And market participants also have the opportunity to route orders to over 250 OTC venues today. And so what this did then was it also had an impact on average trade size. So if you look at on-exchange average trade size back in 2004, it was about 440 versus 140 today. And then when you get to the off-exchange numbers, that was over 1,300 average trade size versus just over 200 today. And so you can see the differences across the numbers in the volumes and where you trade and how you trade. But I'd also like to point out the differences in market participants. So back in 2004, retail investors were under 10% of the market, and our market structure survey now regularly shows the retail investor participation rate at around 20 to 30%. And of course, let's not forget about the technological advancements over the last 20 years. Speeds of market have improved greatly, where we were speaking about milliseconds, then it went to microseconds, now it's nanoseconds, and there's this goal of hyposeconds or zero latency. So markets have changed substantially. And with that, order routing complexity has increased, as have compliance costs for brokers. Brokers potentially have to connect to up to 16 exchanges, as well as all the other trading venues offering liquidity, thereby incurring connectivity and market data costs. And I'm going to stop there because I know the others have some direct numbers for you.
Ari, do you want to weigh in on this one?
Sure. Thank you, Peter. I don't know that I'll talk directly to cost, but maybe some of the unintended consequences, if that makes sense. So, look, I think as I mentioned in my opening statement, our experience with the trade through prohibitions comes from the fact that our displayed quotes are not subject to the trade through prohibitions. And so to that end, I guess a couple of points. The Intelligent Cross runs 2 books, a mid-book and an Aspen book. The Aspen book is the full limit order book, with optional display capability. We improve the NVBO over 4 million times a day. As I said, these prices, however, are not readily visible to all investors because the quotes are not protected quotes. It's also important to note that Intelligent Cross provides its full market data feed, IQX, for free out to everybody. However, only a small portion of market participants take that in. So we saw some of the statistics of how many broker-dealers execute on exchanges. We have about 36 firms total that are licensed to take in our IQX feed. Of that, a lot of them are data consolidators or the like. So true broker-dealers who are routing are probably in the 20s, give or take. So begs the question, why don't people take in our feed if we have better displayed quotes? Great question. So we have heard from market participants, and part of this is because of Rule 611, that if they don't have to configure their routers, and people know this a lot better than me, the routers are configured a lot of time for protected quotes. If they don't need to reconfigure it for a non-protected quote, they will not. If they are forced to, they will. The second part of that is, and we've heard about BestX, you can argue that trade through prohibitions have created a landscape where people can take a more conservative approach to BestX. And I'm sure we'll get more into this. So route to a protected quote. If they don't have to route to us, they will not. So this has created a situation, as I mentioned in my opening statement, people are trading through, for lack of a better word, the Intelligent Cross quote. Look up the stats, it's about 377,000 times per day on average. I think that's year-to-date numbers 2025. So it's not insignificant. As I said, we have 2.1% of the volume of the market. So in effect, I would argue from an unintended consequences standpoint, the trade through rule has created an environment where market participants have artificially, for lack of a better word, limited order routing options. Again, we have grown our venue from 0 to 2.1% in, competing on a level playing field in the non-lit markets. So again, what should we do here? As most of you know, we have sought a proposed rule change through FINRA to have our quotes as protected quotes. Let me be clear, it's not because of any particular support for the current trade through regime, but given some of the things I said before, and we want to have our liquidity displayed, and we think that's been one of the things that has been pushed, obviously in this market structure, and we just haven't been able to. So again, let me stop there. There obviously are costs to connect, and I'm sure we'll get into that, but let me turn it over to other folks.
Great, thanks. Maureen, what does the academic literature say on costs and unintended consequences? You alluded to some of it in your opening statement, but.
Thank you. The costs are tricky for academics to really pin down, right? I mean, in terms of compliance, we really can't get data on that. So to be honest, when we look at costs, we really tend to look at what are the costs of execution as opposed to compliance. So I'll pass on the compliance part, Mike, just because that's not something on the other hand, any of you who have data and would like us to look at it, we would love to have it. So just a thought.
All right, thanks. Pankill?
Yeah, certainly. Look, we as a fairly large institution provide all these routing services we discussed. We have to connect to all the exchanges that come on board, and that in our own analysis, it kind of manifests itself in two ways. One is obviously the onboarding aspect of bringing these venues onto our platform, and in our case, it's not just our execution platform; it's also our professional clearing platform, where we clear for many broker dealers in the industry. So for us, this onboarding phase, of just not things that you would think about, which are, connectivity, market data, right, taking in the raw data feeds. But we've got other things that we have to consider when integrating, into our ecosystem, such as, third-party sourcing, procurement, technology, testing, hardware, CAD integration, billing. That's required on the back of these exchanges. When we tally all these things up, just on the onboarding side, it roughly costs us, $1 million when you add all those things up for execution, and roughly $500,000 on the clearing side. So $1.5 million per exchange that comes along. On the maintenance side, the ongoing maintenance side, maintaining continued connectivity, maintaining the upgrades that continuously come your way, making sure that your surveillance systems are up to date. And I think this is one of the unintended consequences of Reg NMS, and many of the surveillance systems over time, did not update quickly enough. We're not leveraging, raw data feeds, and we're leveraging the SIP, and you saw a lot of false positives coming out of these things. So making sure that your surveillance systems are up to date is very important as well. So, we roughly think it's about, the ongoing maintenance for us is about $200,000 a year per exchange. So when you think about the overall cost, it's quite significant when you've got 30 plus exchanges across options and equities that we're dealing with.
Thank you. Joe, so Pankill just gave us some really good numbers in terms of that. Are you seeing similar numbers, or?
Sure. So just to expand on the numbers I mentioned at the beginning, as we all know, Reg NMS predicted a proliferation of exchanges and fragmentation, and we've certainly seen that play out, whether causal or correlated. And it seems to us that when the industry complains about the cost and complexity of 611, they're largely referring to that factor and the number of venues that have sprung up. We did a calculation, as I mentioned earlier, and what we looked at was, and no offense to our exchange friends in the audience, but we looked at venues with less than 2% market share in equities, so right in the middle of Dan's 1% and 3% by coincidence, and 4% for options, accounting for the fact that there's no off exchange in options. And we looked and estimated for the industry, what is the cost of connectivity, market data, and the options regulatory fee. And that equates to roughly $375 million a year. So a gross up of what Panko is experiencing. We also estimate that $375 million is about 2/3 of the total revenue for those venues. So a meaningful driver of the overall operating model for those venues. The complexity, though, also comes from the fact that we believe if you eliminated OPR, we don't think that number would go down materially for a number of different reasons. A lot of us are already connected to those venues. Those of us that do agency routing have best execution obligations, which makes it very difficult to just disconnect from a venue and potentially save the cost. So realistically, we don't think eliminating trade through rule is the fix for that particular problem. We do think there's a few things that the commission could consider to address that particular issue. One thing that we think could help along these lines is revisiting the split of the SIP revenue allocation between trades and quotes and shifting it more towards trading activity. Another change could be introducing a minimum volume threshold before participating in SIP revenue. Another change could be capping the amount that can be charged for fees until a venue reaches a certain size. A couple of things I would say about those particular points. So one is, yes, those are introducing additional cost controls, which is understandably an area that the SEC has not wanted to get further into. But I worry that that's an unavoidable issue that the commission is going to have to deal with no matter what. Even if you remove the trade through rule, there's nothing stopping any exchange from charging whatever they want for those same costs. And so we think that that's an issue in an exchange marketplace that is going to have to exist no matter what. The other thing I would say is that's really it. I'll stop there, but.
Great, thanks. Before we move on to the next topic, I just want to make sure nobody else wants to weigh in on this particular one. Yeah, Dave?
Yeah, I think these, very specific costs aside, from the unintended consequences of, and it's hard to talk about specifically Rule 611, it's really Reg NMS as a structure has had many unintended consequences. If you think about it, we went from a situation where we had most of the trading on one exchange, but really almost all of it on two exchanges and many, many market makers, to a situation in which we have so many different exchanges and complete fragmentation and very few market makers. And so that cost of concentration on the one hand in market makers and broker dealers, as we saw in the presentation earlier, the lower level of competition results in significant costs that the industry and investors are bearing. And the fragmentation, the extreme fragmentation in the exchange space has just driven latency arbitrage and the speed race to zero, which results in more rents that are being extracted from the market if we're talking about the costs and the unintended consequences of this regulatory framework. We've seen this increase in complexity and these interlinkages between exchanges and complex order types, but of course, that's both Rule 611 as well as the ban on locked and crossed markets. There's no incentive for exchange consolidation. Exchanges run parallel, nearly identical order books. And as we saw on the chart earlier, 7 out of the 8 exchanges that are less than 1%, most of which are copycat exchanges, are run by the 3 major exchange families. Exchange monopoly power has resulted in excessive costs for connectivity and data, and that's these costs that we're hearing about. And this is another form of rent extraction. And I think that the other unintended consequence has been that these rules have driven so much trading off of exchange. Once again, that has led to concentration, and that has led to a lack of competition for filling both off-exchange orders as well as a degradation of the NBBO. And Rule 611 had a dual purpose: ensure order execution at the best possible price and encourage displayed liquidity. But right now we're sitting at over half of all trading off-exchange. We're seeing much of displayed liquidity unprotected because of the odd lot issue. And while we're seeing incremental improvements in displayed liquidity over the past years in some of the most liquid names, this one-size-fits-all market isn't working for all of the less liquid stocks. And finally, in terms of these unintended consequences, we've also seen a complete erosion of best execution. And I do think it's important. I wanted to quote a 2018 XTX comment letter that despite repeated statements in the regulation NMS proposing and approving releases that OPR was not a substitute for best execution, it has effectively replaced best execution. And I think that's another cost that is hard to quantify, but is very problematic.
Yeah, so on that, I want to go to best execution now. It's one of these ones that was not on my script, but keeps coming up. So we'll, it's a marketplace of ideas, so we'll go with that. So Ari, I know you wanted to weigh in here.
Yeah, I just wanted to say, look, I acknowledge the costs of connecting to a new venue, and if Intelligent Cross gets a protected quote, that will enter the argument. But I do think going to best X, you have to think about how do you counter the proclivities of folks not to take in, again, the experience that we're having now, an unprotected quote, because they don't have to. So I never thought I'd be agreeing with Dave Lauer all the time, but yeah, you got to take a look at best execution because you can't ignore it. It plays a factor in here. I think on the minimum threshold, just one point. Again, if you want to fix a minimum threshold and tee it off of the revenue you're going to get, okay, I think that's something to look at. But if you're going to just say 1% protected quote or not, or 2% or whatever it is, I think that puts the commission in a position of picking winners and losers more than they necessarily are now. So again, something to think about.
Dave, since you're in agreement with him, do you want a counterpoint here? Or?
It's weird. Ari and I agree. No, I do think that BestX is sort of the elephant in the room, and we're going to hear a lot about how great it is and how everyone's got all these policies and procedures in place, and effective overquoted is amazing and all of that. But I want to say that what we have seen in reality is it is not enforced. There are not enforcement actions around BestX. There are a tiny handful. They're mostly tiny. Sometimes they're folded into other enforcement actions, or it's all about whether you adequately disclosed certain things. But the current BestX regime has resulted in something that is unenforceable, that has been likened to trying to nail Jell-O to a wall. And as a very simple and obvious example, FINRA has been very clear and explicit. The brokers cannot route orders, quote, in a manner that reduces price improvement opportunities that otherwise would be available to those customers absent payment for order flow. That's a quote from FINRA guidance. And then the head of one of the largest market makers out there goes on national TV and he explains that yes, in fact, Fidelity customers get more price improvement than Robinhood, strictly because of payment for order flow. And that is really a huge problem when something so obvious and blatant is not being enforced. And so, I think that everyone here is like, yeah, duh, that's the way it works. Obviously, that's true, but it's not supposed to be. And retail investors are supposed to be getting the best possible price, not just a good enough price. And so one concern is that in the absence of order protection, the retail experience, which has been extremely positive, which you see the NBBO and you know you're going to get it, or you know you're going to get something even better than that, could be improved through enforceable BestX standards, better BestX disclosures, and then I think you could consider whether order protection still has a role. But any changes to reduce trade-through protection, such as a market share threshold, has to be accompanied by an enforceable standard of BestX or an order-by-order standard.
All right, great. I know Maureen wants to jump in here, and then I know Jamie has a question right after that.
Let me just give some numbers that I think are kind of interesting. These are from recent research papers that I've done with several people. One of the challenges that you do have is for retail trader odd-lot trades are extremely important, right? And they're huge now in the market. But it's 60% of the time there's a better odd-lot bid for Amazon, 54% of the time for Google. Across all price groups, 26% of the time, there's a better odd lot quote. So when we talk about best execution, those aren't protected. One of the interesting things as you sort of look at this, you say, well, odd lots are tiny, they don't matter, but they do matter. And it's kind of interesting. If you look conditional on a spread being at least one tick, greater than one tick, right? If it's one tick, it's really hard to get in there. But greater than one tick, 42% of the time, there's a better odd lot quote. And if you look across at odd lot depth, you may say, well, there's just not that many of those, but there are, right? What we found is odd lot depth is about 15% of the NBBO depth. So as we look at this market, when you talk about best execution, there's this gaping hole, right? That's on the retail side. When you look on, there's another large quantity of non-displayed orders, the hidden orders, right? And one of the things we haven't spoken about enough is that I think the order protection rule led to a dramatic increase in the complexity of orders. When you look at all the different order types the exchanges offer, right? The hide not slides and the various other things. Why is that? Well, in part because, as the exchange has already pointed out, when you think about prices just as the protected quote without bringing in all the other costs of getting to it and the costs of trading in terms of the rebates and whatever, people don't want to necessarily slide to the best price. And there's a nice paper by Mao Ye looking at a sample from, I think it was 2016, that found that more than 50% of the orders at NYSE now have some sort of order protection to not go there. So that's a problem. Let me end up with one last thing on hidden liquidity. Right, hidden orders now, like displayed, non-displayed orders, right, provide about 39% of all executed trading volume, and it rises to 83% for high price stocks. When you look at a Google, roughly pick any given day, you're going to find maybe 10% of the executions are against displayed liquidity on exchanges, just on exchanges, not over here with Joe, right? But when we look at what's happening in the market, that there is an active, I would like to say, hidden world out there now that is almost as big as the displayed world in many stocks. That's not protected. And it's extremely important to understand that, because in some recent work we've done, I've done with Robert Bartlett out at Stanford, one of the things we found that was kind of fun, conditional on finding the hidden liquidity in the exchange, right? We found that the execution quality of executions exceeded that of the non-exchanges, except for the largest price group. And, that may seem surprising, but it's because if you find the hidden liquidity on the exchange, you actually are getting much better execution. If you're just executing at the displayed liquidity, the off-exchange guys beat you all the time, by definition in part, because they have to beat you. But it can be de minimis, right? Whereas if you can go out and get all of that hidden order flow that you're not seeing, the best execution is important. So again, going back to what are we talking about? We're talking about trade through. I think trade through is not guaranteeing best execution. And that's one of the things that I think they thought it would do.
Joe, I'm not sure if it was you on TV or not, but there might be something on your mind. I'd also...
It wasn't me, but there is something on my mind.
Also, as part of your response, it'd be good, I think, for the group to hear how you think about your explicit costs in the context of best execution. The notion that exchanges could continue to increase rates without impacting your routing decision. How do you think about that trade?
Yeah, I appreciate the question. Yeah, I think there's a lot of things running through my mind. I worry that we're also conflating a lot of different things that are loosely related, but maybe not directly tied to the trade through rule. I'll say I couldn't disagree with Mr. Lauer's characterization of best execution more, but a couple of things that I'll put out there. So one is speaking for us, I mean, and I think speaking for a lot of other folks in the room, I would say that the best execution standard that we hold ourselves to and that the industry holds us to and the regulators hold us to is extremely stringent and extremely thorough. And I agree with Maureen, it is not the trade-through rule. I think the trade-through rule is one level of best execution, but the standard that we are all held to and how we execute client orders, and I think this is pervasive across the retail space as well as the institutional space, is very much dictated by where you're going to get the best execution and not necessarily a protected quote. So we connect to, I think, 40 non-protected venues that we incorporate in the execution that we do for clients. I also think, we're talking on kind of both sides of the issue. On the one hand, some of the comments I think are heading in the direction of saying we should have more protection. We should have protection for dark. We should have more protection for odd lots. And then we're also saying, well, we don't need the trade through rule or we don't need to protect different venues. And I think those two things are a little bit in opposition to each other. And I think we do have quantitative measurements of execution quality, which the SEC has been very rigorous at enforcing and, as everyone knows, is in the process of updating. And I think those quantitative measures go a lot further than, qualitative comments around whether people are getting good execution or not. But I do think that there are certainly standards that everyone adheres to in terms of making sure that the execution that people get is best. I think that incorporates non-displayed liquidity. It includes odd lots. It includes a lot of things that aren't maybe protected or aren't currently explicitly displayed. I think that's why we have changes going in to make odd lots on the tape and things like that, just to make them more accessible and easier to access. But the fact that those are not part of the current arrangement doesn't mean that they're not being incorporated when people execute. Did I answer your question, Jamie? Sorry.
Yep. Okay. All right, good. So I know a bunch of people want to jump in here. I know Panko was sort of first, Chris Solgan I saw next. A couple things that have been put out on the table, which is what I actually wanted to get to, is sort of differential effects. Maureen mentioned high price stocks versus low price stocks. What about illiquid versus liquid? The staff, showed their numbers, stocks versus ETFs. Is there any differences there? Folks want to talk about retail trading, institutional trading, the odd lots issues, a lot of different issues that are put out there. Then we'll get to, after this discussion, we'll get to options versus equities and stuff, and then some of the other things. But I know, Panko, you wanted to weigh in here, and then we'll get Chris Olgan, and then whoever else wants to weigh in.
So I think, one thing people need to consider is that, we're here talking about 611 order protection, but for us folks that run big, algorithmic SOR services globally across the globe, we have to provide, we have a fiduciary responsibility to provide best execution. And in a majority of our markets, there is no order protection, right? We go ahead and we stitch that back together. And, in fact, we in Europe, we create the EBBO. Here we have a synthetic MBBO. So all of that is part and parcel, part of the foundation of best execution. But our clients, both institutional and retail, in our minds have never had better best execution. If you think about the amount of data we collect today, the level of analysis that we do, the trials that we run across all of these venues, whether they're dark or lit, whether they're protected or not, it's pretty extensive. And we see, for us in particular, a lot of our flow actually is operating in an unprotected world, right? 70% of the trades are odd lots, right? So if we look at the reality of the situation, when we go back and see, how odd lots have performed, whether we're posting them, for example, in our retail business, about 80+% of our posted orders are actually odd lots. So they don't even qualify for order protection, yet they're very rarely traded through. Similarly, on the institutional side. So I think, for us as a whole, irrespective of whether there's order protection or not, we are providing best execution, that fiduciary responsibility. We are making sure that whenever we see good prices, we're taking advantage of them. But we're also factoring in, especially on the institutional side, other characteristics. How big is the order, right? Is there is there a risk for information loss if we execute on one venue versus the other? So all of these things come together, and really there's 7 to 8 levers that you leverage as part of your best execution philosophy. That Rule 611 is really just one of those levers, and like I said, we don't have it in a lot of our marketplaces.
All right, great. So we'll go Chris, then Katie, and then I know Julie wants to get into it.
Yeah, I just wanted to go back to costs. We understand the costs in the aggregate. The numbers sound, obscene. But when we look at it from the MIAX perspective and from within our own exchange ecosystem, when we launch a new market, we at times waive market data fees and connectivity fees for a period of time until that market's robust. And then when we do file fees for those, and as we've had over the last number of years, we try to cost justify those fees and show our costs in painful detail to commission staff and to show the margin that we make on those. And having the personal experience of writing those filings, they are very thorough, very detailed, and very painful to put together. But with that, we'd like to think that ultimately the cost and the fee that we charge to access our markets, that market participants actually feel value outside of having to come to us if we're a protected quote, in the experience, the technology, the determinism, and that they actually find the fee to connect to our market worth the money that they're paying to connect to it. But that being said, we consider, we really think and have sympathy for the amount of fees that we charge, and we try to make the most detailed disclosures about our fees when we do file them with the commission.
Katie?
Sure. I'm going to tie a couple things together here. One of them is what was just being said by 2 of my members, that Best X is not just about the best price and whether that's protected or not. There's a lot that goes into it, and it can be argued that Best X underpins the investor experience, because this isn't just a regulatory. You don't just have to answer to FINRA that you're meeting Best X. You have to answer to your customers as a broker, and Best X is scrutinized quite heavily by them. Their Best X committees run very rigorous reviews on them. They judge their execution quality and they direct flow accordingly. So it may not be black and white as some would like in a FINRA rule, but from the customer side, it's very clear to the brokers, you better get me the best service that you can get me. And there's review procedures in place. I want to add, not just for the institutional, but on the retail side too, they have Best X committees as well. And if you bring this back to whether this is 611 or there's more of it, again, everything's interconnected. Let's take a hypothetical example on the protected side of a volume threshold to qualify for your protected quote. So some of these numbers Dan ran through just real quick again. 8 exchanges have less than a 1% market share, which is just under 3% of total volume. 6 of those exchanges are under 0.5% market share, which is just about 1% of total volume. Now that sounds like a small number for aggregate volume at that 0.5% threshold. However, that's almost 38% of the exchanges by count. So if you're a broker, that could be a very difficult conversation for you to go to your customers and say, I didn't seek out prices and Best X for you on 38% of the exchanges available. That's a tough conversation, and that's not one they want to have.
Julie?
I would kind of reiterate what Katie was saying in terms of the Best X and how the customer side, we're looking at many different things, and technology has changed in 20 years for what customers are looking at and how they're evaluating their brokers. And I think generally, if you're not providing best execution, you're not going to be around much longer. So there's just way too many TSA reports or TCA reports and reports that are ongoing to keep brokers honest, basically. And I also want to point out that we're speaking a lot to, or the reason some of this rules came about was focused on the retail, but when we're talking about best execution and we're talking about institutional orders, again, it's not just the pricing of Best X. It's sometimes when you have to sweep the book or do the ISO orders as well, that's creating slippage and not necessarily providing the best execution for institutional orders as well. So it's looking at where's the liquidity and are we reaching that? And then while I have it, I just want to say to Maureen that a lot of our members, I had a lot of conversations around the cost of compliance. There is no data, but maybe we can talk on specifically the cost there. But there's a lot of pain points, even though some of the numbers said that straight through press thresholds were low. A lot of the back office people that are dealing in the manpower hours that are going into dealing with trade through issues, matching up with also FINRA too, has become quite a pain point too.
Right. Before we move on, yeah, Chris.
Can I jump in here just real quick on best ex? I would agree with many of the panelists, probably not my esteemed panelist, David Lauer, but the best ex that I think by and large people are using stringent best ex, and then they're going to the place where they can get the best execution for their customer, however they define that, using a whole bunch of different criteria, as Pankil said. And OPR, or the protected quote, is just one of many, many things they consider. Also, think back, Katie had some great stats. 2004, 10% off exchange. Today, we're well over 50% most days. We're talking a lot about small exchanges, 8 exchanges that have less than 1% and might have a protected quote. It's a shrinking part of the market. We're not talking very much about the part of the market that's growing the most. It's off exchange. And I think that actually says that people are seeking best execution. They obviously run exchanges and we look at them, but we have OPR that helps us supposedly, but it's not helping us to grow that part of the market. The part of the market that's growing is off exchange. So, and evidently people are going there for a whole host of reasons, but I think some of them are likely because frankly, you can do things off exchange in a competitive way you can't do on exchange. I think we ought to look at why is that part of the market growing versus the part that we're focusing on because of Rule 611 and potentially the costs associated with that. I think there's a lot to celebrate in this overall market, but I think that maybe we could shift our focus a bit there.
Yeah, before we move on to options and stuff. So Peter, did you want to weigh in on ETFs? I know you have a particular emphasis on that.
Where I wanted to talk about was, or I thought was of value, was to provide a little bit of background on the threshold rule that we do have in Canada.
Yeah, we'll get to that on the next one, but I just wanted to see if you wanted to weigh in on ETFs first.
Nope.
All right, good. Dave, and then we'll move on.
Yeah, just real quick, just to clarify what I was talking about, and what Pankil is talking about, my experience with working with institutional investors doing quantitative analysis of broker order routing algorithms, that it's a different world for best ex, and it's not what I'm referring to. I think institutional investors, the most sophisticated ones especially, do an excellent job. I'm really speaking specifically to the retail experience. And when we talk about how much trading is migrating off exchange, there are certainly a host of reasons, but the primary one is payment for order flow. And the fee-sensitive routing is still an issue in markets. And you still see executions taking place on markets that don't provide the best execution quality because the ones that do are charging a slightly different set of fees.
So before we leave best execution for options, I just have to say, or else I think Matt Kinnack will yell at me, that sort of the institutional investment experience is profoundly retail because retail owns mutual funds. So think through all those tricky institutional best ex questions in the context of this discussion, please.
All right, thanks. All right, so moving on to options. So we'll get the Chris's involved here. Chris Isaacson, why don't you go first here? As I think Dan mentioned or the staff mentioned, it was Jesse actually. Option markets operate under a different plan, the options plan, which is sort of their version of 611 for equities. Love to get your guys' perspective on that.
Yeah, as I said in my opening remarks, we believe the options market structure is fundamentally different. Many of you all know this. This room is full of extremely smart people, but obviously there is no off-exchange trading in options. Every order has to be exposed for competition of some sort. It's quote-driven versus order-driven. You do have a whole series of different auction types that where orders are being exposed. Even if you look at the trade-through exemptions that were shown by Jesse before, like half of those trade-through exemptions are because of multi-leg. So complex orders make up a large portion of the options market, given complex order strategies that are in options. So as you saw the growth, especially since zero commissions have come into vogue, we think the options market is incredibly strong and resilient, as has been shown through especially the past few years. So we don't see a whole lot of need for change here. A couple other statistics there, nearly 2 million strikes in U.S. options today. So 2 million, almost 2 million different order books, 1.8 to be exact, versus a few thousand corporate listings or ETPs in equities. If you think from a messaging perspective, all of you see this in your systems, it's about a 50x messaging problem as well. It's completely different than any market we see around the world. We operate all over the world. U.S. options is incredibly unique because of its quote-driven nature and these attributes. So also education is a huge part of the market. It's important in equities, but even more so in options. And CBOE has been dedicated to education for 40 plus years with the Options Institute. And part of the growth that you saw on the chart there from the staff was that obviously people stayed home for COVID. They started to learn how to use options, and many retail brokers and others have educated them. And we see incredible retail growth and durable use of options that is unabated and healthy. And another statistic some people have been concerned about what are retail customers using options in unsafe ways. Not 100% of the time, but I would say 90 to 95% of the time, what we see from retail brokerage platforms is that people are coming in with cap risk, either just paying their premium or they have some complex strategy where they're risking $2,000 to $4,000 on average. So it's incredibly healthy ecosystem within U.S. options. And we don't see that many trade throughs. And the trade throughs that we do see are usually under exemptions that make a ton of sense to us. So in this case, do no harm within the options market. We think equities market probably is in need more of a review, but they should be reviewed separately.
Chris Olgan, do you agree with him?
Yes. Yeah, the trade through rule was already a major part of equities and the options ecosystem when MIAX first launched in December of 2012. That gave us the opportunity from day one to build and operate our technology to ensure order book processing was highly efficient and deterministic for a trade through world. Our experience with trade through prohibitions in equities versus options markets have been different, primarily because those markets are fundamentally different. We agree with CBOE on that. And we again urge that they be considered separately. For options, we believe there's less of a need for change. From our perspective, the options markets provide a vibrant, healthy, and competitive trading ecosystem fueled by technology and innovation. At MIAX, we work hard to provide a resilient and deterministic options trading environment and continuously work to improve the growth of the U.S. options market. Options further differentiate itself from equities in other ways, right? There are only displayed orders in options. There is no over-the-counter trading, which ensures the value of the options market's NBBO. And because of this, it's self-policing, right? Who wants to trade at a worse price? So, and also with options, in addition to providing mechanics for order protection, like ISOs and routing, features such as improved allocation carve-outs, more widespread use of on-exchange auctions, and a healthy trading floor environment means that substantially all orders, and I agree with CBOE on this, that enter the options market are subject to a competitive process. So we think there's little to no need for change on the option side. On the equity side, we feel differently, but we'll pause there.
Yeah. So Joe, I'd love to get your perspective on this, right? So they both agree that equities are different than options. Chris Sullivan said less of a need for change. Chris Isaacson said no need for change in options market. Where do you fall on this?
I would say, so we're the largest U.S. market maker in equities and options. We're the largest internalizer of retail flow. So we have a lot of experience in both products and as a market maker, as well as handling client flow. I would say there's nothing that strikes us with respect to the trade through rule that is fundamentally different between options and equities. I think we would agree if we were going to look at either market in more detail. It's a much bigger question than I think just the trade through rule that we would want to look at. But I don't think you can argue from our standpoint that the trade through rule is more or less relevant or impactful in equities versus options. So I think we stand by a lot of the fundamental views of taking it out doesn't necessarily yield any improvement. The numbers I quoted earlier of the smaller venues. About 200 million of the 375 million that I quoted is from the smaller options market. So, I think you have a similar kind of dynamic that plays out in both regards. I'd also say that, you can argue with the investor experience in both markets. The retail participation in equities and options is extremely strong and robust. You can't argue with the facts that retail investors have an unbelievably good experience in both markets. They trade differently. They have similar, if not even greater levels of complexity in options. If you look at, some of the dynamics between on and off exchange and equities, I think are probably more complex in terms of how the auction mechanisms operate and how the markets operate in that fashion. People could argue whether one is better or worse, but the end result is retail investors have an unbelievable experience in both markets. So we wouldn't see any significant contrast to be drawn out of the gate. I can understand exchanges, having been in that seat, looking at the amount that trades off exchange in equities and the amount that trades on exchange in options, and looking at the fees in equities and the fees in options, saying leave options alone, we shouldn't change equities. But I think it's a much more complex question around it.
Chris,
Can I ask Joe a question? Of the 200 million you said that were related to options costs, how much of that was ORF?
I don't know that off the top of my head. We can add that to the comment letter we're going to put in, but my guess, don't hold me to this, is it's probably around half.
Yeah, I think we've been on the record, or we'll be on the record soon. I mean, we're for ORF reform. There are certain subsidies in equities. It has to do with, the tape plans, and people have talked about SIP allocation, quote versus trade, and we'd favor some review of that to make sure there's not quote harvesting in equities. But in options, unfortunately, it's an arcane way in which ORF fees are collected by entrants into the space that we think is definitely in need of reform.
Guys, the ORF panel is ORF roundtables in 2027. So
I had to get it in there, Jamie.
I think Pankel's got something on his mind.
No, I was just, we got to ORF, which was, I think, the main driver. I do look at the option space when you think about quote-driven market, all the strikes, yes, retail is having a great experience, but why do we need so many, right? There's just not enough differentiation. And I think the cost on this one is massive, right? Because as was mentioned, the quotes that get disseminated from all these platforms, it's just another thing that brokers have to account for in their smart order routers. Look at CAT, right? 98% of all CAT messages, I think, were options related, right? And have blown out the cost of CAT. So we just have to think about these things collectively. I do agree that I think the protection in this space is not the issue. But again, there is a significant undue cost and complexity that is introduced by having this many options exchanges.
Anybody else want to weigh in on options before we move to Peter to talk about Canada, and we'll talk about other markets? All right. So Peter, you want to talk about Canada? I think it's a really important thing for us to discuss. What about other markets that either have different trade through protections or no trade through protections at all? Because we can't directly look at a counterfactual history. What if we had not put the order protection rule in? But what we can do is look at other markets and get experience from them that have either slightly different rules or no rules at all. So Peter, why don't you start us off here? And I know a lot of folks want to weigh in on this one.
Yeah, just a quick history. In Canada, we don't have a SIP, as I mentioned earlier. So when we had one marketplace back in 2006, the TMX, they were charging data fees to the street of a certain amount. And each new market, when competitive markets were onboarded, was able to charge data from day one. We were forced to connect to them because we had the notion of a trade-through rule. So we were forced to connect to those marketplaces early on right away, and they were able to charge for market data. So What we were finding in Canada was a proliferation of markets that took place from the period of 2007 through to 2012. These markets were non-differentiated and were able to charge for market data. And as was talked about earlier, the connectivity costs upfront were very material to the brokerage community. So around 2012, the regulators began to look at putting rules in place that would eliminate or at least create some sort of threshold required for marketplaces to have orders protected. And in 2016, they introduced a rule that said, and it was originally proposed at 5%, but was lowered to 2.5%, that any market that had some form of a speed bump or a delay or had less than 2.5% market share was no longer protected. That happened to be coincident with the last new marketplace we saw launched until one that's going to be launched later this year. So it literally has been 10 years. I don't want people to think that the reason there have been no new markets is because of that rule. I would argue it was more coincidental than anything else. And as I mentioned earlier, it was more driven by the industry's need to stop the parabolic increase in real-time market data fees, because these new marketplaces had no rules with respect to how they charge for data from day one. So in coincidence with the threshold rule, the regulators also created a rule that said your market share, or the percentage of fees associated with real-time market data needed to be somewhat linked to your market share. And that allowed the market to at least slow down the increase in market data costs. So arguably, to the point we've heard earlier about whether or not a threshold rule would lower costs on an ongoing basis, I don't think anyone disconnected from any of the venues that were less than 2.5%. Once you've dealt with those upfront costs plus the combination of best X requirements, essentially you've onboarded and absorbed most of the costs. So I don't anticipate that you would see a significant number of people disconnecting to those additional marketplaces, especially if they're affiliated with exchanges you're already connected to. Quite possibly that reduces costs with respect to gateways and the like. The brand new marketplaces are the ones that require the significant upfront costs, like 24. If you want to connect to them, you're going to need to create your own or pay for all the associated costs of connecting. So again, I think the message there is that the threshold rule, yes, it did slow down or eliminate the proliferation of marketplaces in Canada, which I know is a goal a lot of people have with respect to 611. But it was, again, more due to market data issues that the U.S. doesn't face directly that we were facing in Canada.
Does anybody else want to weigh in on Canada or other venues?
Yeah, I think it's instructive, but probably, not to be lifted from Canada to the U.S. I mean, all due respect to Peter, as he said, Canada is much smaller. We obviously operate many venues in Canada through our acquisitions over the last few years. I think it's also important to note, I mean, the effective trade at rule there is quite a bit different market structure than in the U.S. And we can discuss whether or not a threshold makes sense, but we have not seen, even though we have one venue because of a delay that's not protected there, we have not seen disconnects dramatically because of that. So that's been our lived experience as well.
Yeah, I'm not suggesting in terms of the trade at rule, if you look at dark trading in Canada, it's only 5 or 10% of the market. So I know there's been a lot of comments here about the proliferation of dark trading. Certainly the trade at rule that exists in Canada is the primary reason why we have a very low percentage of trade that happens in the dark or off exchange. That is absolutely the case. Whether that's good or bad, you can debate, but that is definitely true.
That's a side, yeah. I guess maybe we'll have the mic. I'll mention, obviously, we operate the largest pan-European exchange, both in the UK and Europe, and where we have a broad range of competitive leeway there. So we compete for a whole bunch of different trading mechanisms: on exchange, off exchange, exchange trade reporting, a list of off exchange services there. There is obviously no Rule 611. There is no order protection and Best X. There's Best X policies there. Some would say more stringent, some would say less than here. The market has figured it out there, and so have we as a competitive exchange. So we could live without OPR, but as I said in my opening statement, I don't think that getting rid of it without looking at everything else, given the U.S. size and structure, is wise. But in Europe, we've seen quite a bit of growth given the ability for us to compete across the full spectrum of trading mechanisms.
Thanks. Joe, Citadel obviously operates in a number of different markets. What sort of insights can we glean?
Yeah, I would just make two observations. One, we are quite active in Europe, including on Chris's venue. And I would just be cautious about drawing too many conclusions about the US versus Europe. You look at the amount of volume, retail participation, the cost structure in Europe, and there's clearly, some good companies and some good markets, but it pales in comparison to what we have in the US. And again, back to my earlier points, figuring out the contributing factors and the positives and negatives of some of the rules that we have in place here are very difficult. But I think pointing to one other market that has figured things out, which we agree with, but then saying that's evidence that we should make the US market look more like that, to me is a problematic thought process. The other thing I would say is, we didn't talk about this directly, but just back to the opening presentation, I would also be very cautious about drawing conclusions about pre-post trading and regular day trading when 611 is in place versus pre-post when it's not, because I would argue that at least for us, but I think for a lot of participants, everyone operates as if 611 was in effect during those periods of time. And so I would just say, if you don't see incidences of trade-throughs in those sessions, I don't think it's accidental. I think it's somewhat intentional. So I would just keep that as a backdrop.
All right. Chris Hogan.
Yeah, so having an equity exchange that is small and could be impacted by any potential volume thresholds, we kind of did some research and have some thoughts on this, right? So, what do you calculate, right? Do you just look at only on-exchange market share versus total market share, including the TRF? Should we also exclude opening and closing auctions from volume, which is not protected today and can skew calculations? So it doesn't seem fair to hold an exchange liable for volume in markets in which they can't compete, such as over the counter or in the auction space. Also, a non-protected exchange may have more volume in certain names than a protected venue. And how do you reconcile not protecting one over the other in that name? So importantly, the trading volume threshold could be viewed as arbitrary. And then looking at like data on MyX Pearl, if our volume actually doubles when you exclude TRF data, we could also be higher if you exclude opening and closing auctions that are not protected. And actually in tape B, at times we could be over 4%. There's also volume in select symbols and tapes that exceeds exchanges with overall higher trading volumes. So, and we're also at the NBBO at a higher percentage in certain symbols than other exchanges with higher market share than under a threshold would be deemed protected. So why should those exchanges be protected when they have lower volume in select names or providing poorer execution quality and depth in those names than we are? So we would find that hard to reconcile. We would challenge anyone to reconcile a trading threshold with some of those aspects.
Katie, did you want to weigh in here?
I think what I'd just reiterate for both Canada and Europe and all the other regions in general is that, yes, the markets are extremely different. I wouldn't just say very different. I would say the US market's extremely different from everything from the quality of the listed companies that are out there to trade, to the volumes, to the diversity of market participants. I would also concur from what I hear from my members with Peter that no one disconnected in Canada just because they were below that volume threshold. And then in Europe, they do use a best X regime. They actually, put more of a regulatory spin on it for Dave, they actually are looking at what we all look at on a customer perspective, let's call it, its price that's quoted plus the external costs. So these are the venue fees, clearing and settlement fees. Everyone knows Europe has a lot more CSDs than we do over here with our ones. So those costs are higher over there. Speed of execution, likelihood of percent of order getting executed, size, nature, et cetera. They are reviewed on those by their national regulators, but I would point out that a few years ago, both the UK and the EU got rid of the formal published reviews of those best X because they just found that they were not used by investors and they were very costly and difficult to produce, and the cost benefit analysis was not there.
So I know Peter wants to weigh in again, and then Ari, you want to say a few words?
Just a quick comment that we heard from MyX. I caution the commission, if we're looking at a threshold rule, to avoid the complexity arguments that we just heard. If we get into individual stock market shares, it's just going to blow everything up in terms of complexity here. So I do think we have to be very, very careful. The threshold rule is at the marketplace level in Canada. And I'm not saying Canada by any means should Canada necessarily be a guidepost for how you would structure a threshold rule in the US. But the flip side of that is if we get down to looking at market shares on individual stocks or trying to take away certain parts of the market from that calculation, I think it'll be a rabbit hole you don't want to go down.
Yeah, just quickly, we weren't advocating a per share or a symbol range threshold calculation. We were just trying to show that what some of the issues could be in trying to set a threshold to be protected or not.
Thanks. Ari?
Yeah, I guess just to reiterate what some of the other panelists said, I mean, if and when, hopefully, we have a protected quote. I mean, is it 2.1%? Is it the overall market volume? How do you define it? The devil's in the details, bottom line. But, hopefully allowing for innovation and the next intelligent cross to come, at least having an incubator to get up to that 1%, 0.5%, 2% threshold would be great. So it's gonna need a lot of thought. The only other thing I'd say is before we run out of time, I feel like maybe I need to clarify my support for Dave Lauer, given the rest of the panel on Best X. But now I feel hesitant to
I'm used to it. It's okay.
But yeah. But just to clarify on Best X, one last point. Look, again, we've gotten to where we are as a venue because people are not just looking at price, they're looking at other factors in going to intelligent cross. What I was, I guess, trying to say back at the beginning of this panel is people are just not taking in our quote, and we hear that is because of either we're not protected. So if people want to take in our quote, great, we'll sign everybody up tomorrow, and then they can decide whether to act on that or not. But the point is we're just not seeing people take in the quote, and we've heard part of it is Best X.
Yeah, Dave, and then
Joe,
you
myself, Dave, from supporting you.
I think that one thing to consider as well in Canada is that Canada is a good example of a market in which listings saw innovation and saw disruption. And that has not happened in the US for quite some time. And any consideration of something like a market share threshold, I don't know if there's a great way to do it, but if you do something like that and you don't consider potential innovation in listings, you've pretty much entrenched the listings duopoly here in the US. And that is an area where there is, and I'm an advisor to the Green Impact Exchange. It's a new exchange that is about to launch, and they're innovating in listings. And I think that is something that we should want to see. As I talked about earlier, here we've seen fragmentation without innovation, and it's all been about copycat exchanges and latency, rather than innovation in listings, where one exchange did try to do it. I think that's something that we should encourage. And so we should be looking for ways to encourage innovation in parts of the market that haven't seen it, and be more thoughtful about how we make exchange approvals before we continuously approve copycat exchanges.
Joe?
Just one quick clarification, and agreeing with Ari on part of his point. So we may not agree on the style of quote that needs to get protected, but I wanted to be clear that our suggestion on a minimum market share threshold was for economic benefits, not for protected quote benefits. So we do think that having a threshold that introduces whether you have a protected quote or not can be potentially confusing to the marketplace and difficult to administer. That was why we were intentionally suggesting that the market share threshold could be used to control the economic incentive to conduct another medallion versus whether you have a protected quote or not.
Chris, did you want to weigh in here, Chris?
Oh, no, not right now. Thank you.
We're almost done, so I'm going to ask folks to if you have one last word, go ahead.
Sure. Yeah, a lot of the focus has been on exchange proliferation and copycat exchanges. And it's not that exchanges don't want to innovate. We do. But we are subject to Exchange Act standards when we file rule filings to adopt new technology or new functionality that has to go through a commission review process. And no, not directly commenting on Jamie and his staff, but past staff have made it difficult for exchanges to push through things that are different. Everything has to be apples to apples. And the easiest way to market is to copy someone that's already doing it, that the SEC has already approved. So it's not that we don't want to innovate. We are just a little hamstrung in innovating as compared to the over-the-counter market, which is able to innovate in a much more free form than exchanges are. And we would welcome the opportunity to innovate and to add more functionality to our markets should the SEC allow. Thank you.
Chris, it's a brand new day at the SEC.
Your mouth to God's ears.
A renaissance, yeah. So we're going to close in just a minute here. Ask the panelists if there's anything that we did not get out on the table they want to, not to reiterate stuff we've already talked about, but is there any issue that we haven't teed up that we want to get in the transcript for feedback for the commission or to tee up for the next panels? Yeah, Joe.
I'll just say very quickly, I think this sort of came out, but it might be worth just spelling out. I think the one thing that came through very clearly in everyone's comments, whether explicit or not, is just the myriad of rules that have some tie-in with 611, right? You've got
the octopus.
The octopus. And just to be, we need to, as an industry and as the SEC, be thoughtful about how all of those fit together. And if we change 611, all the other rules that are going to have to be dressed alongside that.
Yeah. I mean, in your closing remarks, I'd ask each of you to throw those out there. Let's be explicit about the rules that we should review.
I've got a list. Lock cross, access fees, best X, market data, quoting increments, 605, how the SIP operates, reg show, what the NBBO calculation is, the exchange balance of benefits and obligations as a starting point.
I bet you checked that twice.
Did Joe miss any before we close out?
I agree with Joe's list. I'd probably fall on a different side of each of those issues. I did want to put two things out there. The first is if we're trying to reduce cost with exchange connectivity and market data, the answer is a cost plus model, which is something that IEX has been advocating for, and where they have in their filings their explicit delineated costs and then the margins that they're putting on top of that. It's something that Europe has tried to move to with, somewhat not as much success, something that I've also been pushing for in Canada as Canada revisits its market data cost regime. So, I think that would do the most to reduce cost and complexity, not necessarily much complexity, but at least cost. And just to get it on the record, I just wanted to quote Ken Griffin that internalization is one of the greatest threats to price discovery in financial markets. I think it's important to get that quote on the record at all possible opportunities. Thank you.
Joe, do you want to respond before? I know Maureen wants to get in here, but you got called.
I think Dave needs to stop taking out of context 20-year-old things and requoting them. But
all right, Maureen.
I was just going to say, if you want to add in a few more things, just because I know you guys don't have enough to do. As you think about the challenges we talked about, if you do take away, the trade through protections, then obviously the big concern is best X. And so again, here you come into things like what is on the SIPs, right? Which I think is really important. I know you're looking at that, but I think if you're going to be able to figure out how well you did, you really do know more. You need more information. And another area that is very tangential, but becoming more and more important as the retail brokers allow for order executions or order placements in dollars as opposed to shares, then fractional shares become huge and they don't fit anywhere right now. Now, I'm certainly not arguing that we want to protect fractional shares per se, but I do think rather than look at where we are now, we want to look at where we're going to be in 5 years as you make these decisions. And that change in retail, I think, is huge.
All right, thanks, everyone. The great thing about being the first panel is we just tee up all the issues, and the second two have to solve everything. So, and the commission has to do that. Fantastic job, fantastic discussion. Got a lot of stuff into the roundtable transcript for the staff to think about. And for the next panels to think about. I really want to thank Jamie Selway and his entire team for inviting me here to participate in this, in particular Ted Venuti. I also want to thank Chairman Atkins and the Commission for convening this roundtable. This is when the Commission acts best, it really seeks out the public comment from folks, and the experts today have really given a lot to think about. So now turn it over to Jamie for some housekeeping announcements.
Yep. Thank you, panelists. This was wonderful. Wonderful job. Thank you, Mike. Great moderation. Thank you, Vlad, for the coffee. I needed that. We're going to take a break for lunch. We'll see you back at 12:45. Thank you.